witnesses now for this morning's hearing, and I want to start by thanking both Mr. Schiller and Mr. Kabza for being here, and I also want to thank them for their cooperation and their company's cooperation with the subcommittee. They voluntarily provided very important information that helps us to get to the bottom of what we are after here, which is better tax policy, and I appreciate their willingness to do that. I also want to repeat what I said earlier today, which is we're talking here about the U.S. tax code being the problem, okay? And I hope that's something that every person watching or listening today understands. This is about a problem here in Washington, D.C., which is a tax code that's dysfunctional, that's not serving American workers. It's antiquated, it's outdated, and it has to be more competitive. Mr. Schiller served as Valeant Pharmaceuticals Chief Financial Officer between December 2011 and June 2015. Therefore, he has a lot of experience and background that will be helpful to us. Joshua Kabza is the Chief Financial Officer of Restaurant Brands International, which is the parent company of Burger King and Tim Hortons, the Canadian restaurant chain. I appreciate, again, both of you being here this morning. Look forward to your testimony. We do have a timing system, as we talked about earlier. We'd ask that you try to limit your oral testimony to 5 minutes. Of course, all of your written testimony will be printed in the record, and we look forward to the opportunity to ask some questions afterwards. Mr. Schiller.
Chairman Portman, Ranking Member McCaskill, and members of the subcommittee, thank you for the opportunity to appear before you on behalf of Valeant Pharmaceuticals. Valeant is a multinational specialty pharmaceutical and medical device company. We operate in over 100 countries with approximately 45% of our revenue in 2014 coming from outside the United States, with a particular focus on growing emerging markets. For the past 7 years, Valeant has employed and successfully executed on a unique and differentiated business strategy within the pharmaceutical industry. Today's Valeant was born of the 2010 combination of BioVal, a Canadian corporation, and Valeant, a Delaware corporation. At the time, each of Valeant and BioVal were small pharmaceutical companies focused on many of the same therapeutic areas and geographies, with the need for greater scale to compete against larger multinational pharmaceutical companies. This was a merger of equals in which BioVal acquired Valeant. Today, we're headquartered in Laval, Quebec, have approximately 19,500 employees, and with approximately 5,700 of whom are based in the United States. Over the past 5 years, our sales and market capitalization have each grown tenfold to projected 2015 sales of approximately $11 billion and a market capitalization of approximately $87 billion. With this growth, we've been able to expand our operations both here in the United States and around the world, creating quality jobs in the markets in which we operate. The growth and success we've been able to achieve at Valeant is rooted, we believe, in the values and core principles that guide our business decisions. These include, first, a commitment to the health and safety of the patients and customers who use and rely on our products. Second, a commitment to innovation through an output-driven R&D approach, which is unique in our industry. We focus less on how much we spend on R&D and more on what we get out of our R&D efforts. We source innovation through internal efforts, through licensing technologies from entrepreneurs and other third parties, and through acquisitions. We believe the results of this approach speak for themselves, with 20 product launches in the United States alone last year and a rich pipeline of products. Third, a commitment to our decentralized business model, with which each business unit is given control over and held accountable for results within that unit. Fourth, we are committed to a disciplined approach to business development with a focus on high rates of return and rapid payback periods for our shareholders. I'd like to address that last principle in greater detail. First and foremost, we only pursue transactions that make strategic business sense for Valeant. We generally look for businesses that complement our existing product portfolio and/or match our focus on high-growth therapeutic areas or geographies where we believe we can improve business operations. We have a strong track record of deploying our management and business strategy to grow and improve businesses we acquire and provide superior returns to our stakeholders. Second, we take a financially disciplined approach to business development. When assessing acquisition opportunities, we generally seek to achieve at least a 20% internal rate of return and a payback period of 6 years or less based on applying statutory tax rates to the projected future earnings of potential targets. Of course, these are guidelines, not hard and fast rules, and every acquisition involves a significant element of judgment. In particular, as we have previously stated in public statements to our shareholders, with respect to large public company acquisitions, due to the transparency of the public markets and other factors, we have generally accepted rates of return below our stated targets based on our ability to deploy large amounts of capital at returns still significantly in excess of our cost of capital. We do not value proposed transactions and do not decide whether or at what price to acquire a business based on the ability to achieve tax synergies. We do, however, enjoy a lower overall tax, which allows us to generate more cash flow for a given dollar of revenue and leaves us with more capital to deploy in our business, which in turn allows us to deliver higher returns to our shareholders and accelerate our growth. Ultimately, while the tax synergies we've been able to achieve have certainly helped us deliver value to our shareholders, we believe that the execution of our differentiated business model has been the primary source of our growth and success. Our financial guidelines have helped us to stay disciplined in our acquisition strategy, and as our Chairman and CEO indicated last week in an earnings call reviewing past deals, we are exceeding our expectations with respect to our acquisitions overall. You've also inquired about our views regarding U.S. tax reform. I'm not a tax expert and cannot speak to the specifics of any particular aspects of tax reform, but we found the Canadian system to be very conducive to our growth and success, and be happy to elaborate that further during Q&A. Thank you again for the opportunity to appear before the subcommittee, and I'd be pleased to answer questions regarding these topics.
Thank you. Chairman Portman, Ranking Member McCaskill, and members of the subcommittee. Thank you for the opportunity to appear before this committee. My name is Josh Kobza. I am Chief Financial Officer of Restaurant Brands International, and most recently worked in the same capacity at Burger King Worldwide. I am here today to discuss the recent Burger King-Tim Hortons transaction, which created one of the world's largest quick service restaurant, or QSR, chains. I understand that the committee is reviewing the tax effect of the corporate tax code on U.S. businesses and on cross-border mergers and acquisitions. While this transaction, like all cross-border combinations, had certain tax implications, the marriage of these two iconic brands of similar size under the RBI umbrella was motivated by compelling business reasons rather than tax strategies. Our vision centered on combining two brands that occupy a distinct space in the QSR landscape, both geographically and in their menu offerings, to create new opportunities. Burger King is the world's second largest fast food hamburger restaurant, with over 14,000 restaurants in approximately 100 countries and U.S. territories. Tim Hortons is the largest Canadian-based QSR, with approximately 45% of all QSR traffic in Canada. Our new RBI family now includes over 19,000 restaurants in approximately 100 countries. More than half of Burger King's restaurants are located outside the U.S., and we see a significant opportunity to grow the Tim Hortons brand and unique operating model in attractive markets all around the world, beginning in the United States. My testimony today focuses on this transaction as it occurred, rather than hypothetical scenarios that could have any number of potential inputs and points of analysis. In 2013, our management team began to evaluate future alternatives for growth and enhancement of shareholder value, including potential strategic transactions. Through our search, we identified Tim Hortons as an excellent choice, a very high-quality business with an incredibly strong brand and complementary menu offerings, where we could add significant value by leveraging Burger King's worldwide operating partner networks and experience in global development. We structured the transaction in a way that honors the history of both companies. Burger King's headquarters remains in Miami, Florida, and Tim Hortons remains in Oakville, Ontario, with separate management to ensure the integrity of each brand. We plan to open hundreds of new Tim Hortons restaurants across the United States, attracting tens of millions of dollars of investment, creating thousands of new jobs, and expanding the U.S. tax base. As CFO during discussions between Burger King and Tim Hortons, I was responsible for working with our professional advisors to explore how to structure a potential transaction. As these discussions progressed, it became clear that a combined Burger King-Tim Hortons company should be domiciled in Canada. The business case for this transaction was always very clear to us, and closing the deal required careful calibration of the terms and structure of the transaction. Both the Tim Hortons brand and the Burger King brand are revered institutions in their country of origin. But given that Canada is the country with the highest concentration of employees, assets, and income for the combined company, Canada was the logical choice to be the domicile of the newly formed entity. Additionally, The board of directors for Tim Hortons at first declined to discuss any possible combination and was reluctant to engage in serious negotiations until our proposal contained both a higher price and a commitment to locating the combined company in Canada. Throughout our discussions with the company's board and management, it was made clear to us that domiciling the company in Canada was critical to concluding a deal. Under the transaction, Burger King remains a U.S. taxpayer with an unwavering commitment to our Miami headquarters, the surrounding community, and our U.S. franchisees. When compared to the 26% effective tax rate paid by Burger King prior to the transaction, our current effective tax rate is only slightly lower, in the range of a 3% reduction. This modest impact underscores a crucial point. Joining Burger King and Tim Hortons together was fundamentally about growth. Tax considerations were never the driving force for our transaction. Rather, our primary motivation was to realize the greater business potential of combining these two iconic and complementary brands. That is not to say that the domiciling of the company in Canada did not have any tax effects. Canada's tax regime provided both slightly better rates, and its quasi-territorial system provided an efficient and attractive platform for growth. As a combined company, we are focused on accelerating our growth. Our goal is to grow our business and our brands alongside our franchisees, employees, and other partners. In closing, we understand that in recent years, the policy discussion regarding the role of tax consideration in corporate mergers and acquisitions has become more prevalent. In this regard, we welcome the ongoing bipartisan efforts to make the U.S. tax system more competitive to level the playing field. Again, thank you for the opportunity to appear before this committee. I look forward to answering your questions.
Great. Thank you both very much. I'm going to start with you, Mr. Kabza, and Burger King. You just made a point that the territorial system in Canada helps with growth, that you have a slightly better rate in Canada. You know, the information you provided us with regard to your decision-making was interesting to me, in part because of what you said about the difficulty of bringing your profits back to the United States. You know, you all were growing internationally. You wanted to grow more, and that's a good thing. But you found that it was hard to bring those rates back. Could you turn to page 29 of the appendix? I think you have that in front of you there. And talk to us a little about this. Is it accurate to say that at the time of the transaction, you expected a lot of your future growth to come from international expansion?
So prior to the transaction, we had gone through 4 years of rapidly accelerating development around the world. I think one of the great accomplishments of those 4 years was to multiply the pace of our growth by about 4 times in terms of net new restaurants.
So you were looking to grow more internationally. So here you are, a U.S. company wanting to grow internationally. And what were you facing internationally? You had, again, looking at the data you provided us, about $700 million locked out in foreign earnings, meaning earnings you couldn't bring back to the United States without paying a high tax rate. Is that accurate?
It is accurate that we had about $700 million of permanently reinvested earnings, and we had made the decision prior to the transaction that we would reinvest those permanently, whether that be through new investments in our growth or through M&A or investments in our joint ventures.
And what were you telling your board that your corporate rate would be if you brought those cash balances you had overseas, that $700 million, back to the United States of America? What was your tax rate you talked about? I think you look at the appendix, there's a number there.
Yeah, I think it's very helpful to look at page 10 of the appendix, and I think it's very important to bring some context to this page. This is really fundamentally the lens that we look through when we analyze the merger with Tim Hortons. And what you have on the left side of the page is our base case outlook, which considered our strategic plan for the existing Burger King business and our existing tax rate, which was around 28-29%. And we thought that with that plan, we could generate a share price of about $46 over the course of the next few years. So when we measured the incremental value that this merger would add, we always looked at it versus that $46 per share. So we looked at how much more value could we add by doing the merger.
And let me just focus you on this one issue, though, that we're getting at. And I appreciate your comment earlier that you hope we could see a U.S. tax code that was a more level playing field. You had $700 million overseas. You were telling folks that under the corporate structure of being a U.S. company, if you brought that back, it would be a very high rate. In fact, I think you said it would likely increase to near 40% would be your corporate tax rate if you were to repatriate those cash balances. Is that correct?
The reason for that analysis was that when we looked at a Canadian domiciled company, we considered that given the quasi-territorial system, we would likely distribute all of our foreign earnings. So as an illustrative analysis, we calculated at a very high level what the tax impact would be if we were to distribute all of our earnings in the existing case. And we used an illustrative rate of 40%, and that's the value that you see on the.
I get it, and that's sort of the point in part of this hearing, to say here you were a U.S. company and saying you'd like to have the flexibility to be able to bring some of those profits back and reinvest here and expand, and you probably also thought this is going to get worse because you wanted to grow more internationally and therefore have more of those earnings that would get into this lockout. So there was a tax barrier. The other issue is, how did you choose Canada as your headquarters? And let me preface this by saying I don't question what you're saying at all about the business reasons to have the combination. I think, from everything I've read and heard about it, that's what motivated you looking at Tim Hortons in the first place, and it sounds like it's working for you from a business perspective. But you had a decision to make. Where's the headquarters going to be? And my understanding is that, and again, I think this is, if you look at page 25 of the appendix, you will see something with regard to this decision-making as to where the headquarters ought to be. You looked at a number of different places. I don't see the United States of America on the list. And I assume, based on the information that you provided us, that was because of the tax consequences. So, yeah, I get it that Tim Hortons wanted to stay in Canada. I'm sure they had lots of reasons for that, maybe some of which had nothing to do with taxes, but certainly one would be taxes. And is it accurate to say that the United States was not even on the list of places where you might want to put a corporate headquarters of the combined companies?
Yes, so as we move through the transaction, I would say there are probably three big factors that drove our decision-making about why the combined company should be domiciled in Canada. First, Canada would be the center of operations for the combined company. It had the largest concentration of employees, assets, and income of the company. And the second reason is that this was something extremely important to the board of directors and management team of Tim Hortons. And in fact, in written communications to us, it was put out as a condition to moving forward and even beginning to negotiate in the deal. It was only after that we put that in our offer letter that the company even began to negotiate with us. Mm-hmm. Furthermore, we had to count on getting approval from the Canadian government under the Investment Canada Act. And we went through a study of all 1,500 cases that have passed through ICA review in the past 25 years. And through that study came to the conclusion that domiciling the combined company in Canada would be a critical success factor for getting through that approval process. And we did not have any exit from the merger agreement if we didn't get approval, except under extreme circumstances, and in which case we would have had to pay a $500 million penalty. So those three factors were very strong factors in driving us to consider Canada. That said, we also looked at the tax effects of domiciling the company in Canada, and as you can see from the materials, there was a reduction in the tax rate relative to the tax rate that Burger King was paying previously, and that's something that was factored into our analysis, into our board's analysis of the deal as a whole.
One final one is just with regard to, again, page 25 of the appendix. The slide seems to be saying that Burger King moving offshore would reduce your tax rate to the low 20s and avoid this 40% effective rate we talked about if you'd had to bring your bring your earnings back from overseas. And you say here that the incremental value creation from tax savings would be $1.4 billion without repatriated earnings and $5.5 billion if you did repatriate. So assuming repatriation, which your presentation does, was it your estimate at the time that placing the combined company headquarters in the United States would have destroyed about $5.5 billion of value?
So the $5.5 billion calculation was a very simplistic, high-level and illustrative calculation that applied that rate to the combined company. Because of the fact that, that we only ever looked in depth and explored with our advisors in depth the tax structuring, among other structuring considerations, of a transaction moving to Canada, we never looked in depth at fully examining the impacts of domiciling the.
So it's an estimate.
US.
It's an estimate.
It's a very high-level estimate.
Yeah, but a significant one. $5.5 billion in a transaction of this size obviously played a huge role. So look, thank you again for your willingness to provide information. We appreciate the fact that the information you provided us is helping us to come up with, as you said earlier, a better tax system. And with that, I'll turn to my colleague and look forward to following up with questions in a moment. Thanks, Senator McCaskill. I have some questions with regard to the material you gave us in terms of the tax advantages of both your initial decision to merge and just as background, you talked about this Valiant U.S. headquartered company had a reported tax rate around 35%, teams up with a Canadian pharma firm called BioVail, kind of a merger of equals, would you say? BioVail had its headquarters in Canada, obviously territorial system there we talked about, which gives them certain advantages, but second, they had a statutory rate of about 27%. How has that merger and being a Canadian company affected your ability to do acquisitions?
Sure. So at the time, as I mentioned in my opening statement, we're equal size, small in the context of the global pharmaceutical industry, in similar therapeutic areas, similar geographies, focused in the U.S. and Canada, and both struggling to get scale. Companies came together. The decision to be in Canada didn't drive the discussions, didn't drive the decision that the merger made sense, but when it came down to constructing the transaction, there was only one possibility if the transaction were to occur, and that was to be in Canada. Because if we were to contemplate coming to the U.S., there would have been such significant dyssynergies that it would make coming up with a price that both sides would agree to and both sets of shareholders would agree to impossible.
Including the tax advantages of going to Canada, as we talked about earlier.
Yes, those dyssynergies I'm talking about are tax dyssynergies.
So you go there, and my question to you was acquisitions. In that short period of time since 2010, you've made lots of acquisitions. In fact, you say you started as a small company, but now you've made $36 billion worth of acquisitions, $30 billion in the United States, just in that short period of time. So I think one of the words you used in the testimony was to kind of turbocharge your ability to do acquisitions. And that's part of, what we're looking at here is not just U.S. companies leaving our shores because of the tax disadvantages in the United States, but also once they leave, then looking back into the U.S. and acquiring additional companies. And you've been very successful doing that. One of the companies that you acquired was Bausch & Lomb. We'll talk about that. Another is Medicis. Another is Salix. And in each of those, you showed us kind of what you were looking for, which makes sense. A company is not going to purchase another company just to kind of make things break even. You want to make a nice return. And you were talking about a significant return you were looking for, 20% internal rate of return over a 6-year and a 6-year payback period. That's the deal. Basically, will pay for itself in 6 years. And in these 3 cases, it looks like you got to that or very close to that because of the synergies, as you say, on the tax side in large measure. Not that these didn't make sense for other reasons. So when I look at these decisions that you've made, I see them as being tax motivated, and they've worked for you. Salix, by the way, we'll talk about first, if you don't mind. Here's a U.S. company. They were thinking about inverting. The federal government, Obama administration comes up with the regulations against inversions, particularly the percentage of shareholders that have to be foreign. They say, well, that's going to stop us from inverting, so let's just become a target of a foreign takeover. I think there were 11 suitors for Salix. I'm sure you remember that because you were one of them. Actually, there were a dozen. I think 11 were foreign. And the 12th, as I understand it, is looking at inverting right now to the Netherlands. So here's a company that was blocked by federal regulations from doing what they were going to do, invert. Instead, they say, let's just be taken over by a foreign company. And indeed, 11 of the 12 companies that bid for them were foreign, and you all won the bid. On Salix, if you look at page 80 of the appendix, I can see where you have laid out some different results based on what the tax rate might be. And again, that makes sense from your point of view. Specifically, this idea that you wanted to be able to show over 6 years that you could get effectively the return to shareholders that would make the deal pay for itself and a 20% internal rate of return. My question for you is, with regard to Salix, is this presentation made by the Valiant management to the Valiant board one that you think was instructive to the board to make the decision to move forward with the deal? In other words, were these tax alternatives that you laid out what really led to the board's decision?
Sure. So as I mentioned in my opening statement, there's no question being a Canadian company subject to their territorial tax regime has created significant benefits for the company and its shareholders. I would describe the benefits and how we capture those benefits slightly differently than as was laid out. As I mentioned in my opening statement, when we look at a target, we're looking at whether it's strategic fit first and foremost. Secondly, we're looking at whether or not the returns are sufficient for our shareholders. It's their money. Deploying capital is probably the most important responsibility a senior management team has. We look at statutory tax rates when we're looking at deploying capital. We look at lots of other factors and run lots of scenarios, including what we think the tax rate would be, a scenario with the tax rate in our hands. That's not a benefit we give to a seller. That's a benefit that we retain for our shareholders. So in the Salix case, the materials you pointed out, the debate in the boardroom was whether a 15-16% return was sufficient to go forward or whether we should wait for higher returns that meet our thresholds. The decision was that great company, it was sufficient, and we put a lot of capital to work very quickly. And rather than waiting for other things to come along, uncertainty in terms of timing, size, quality, et cetera. The benefit that we clearly get is in our hands, a dollar of revenue, we will bring more of that dollar of revenue to the bottom line than somebody that has a much higher tax rate, which gives us the ability to reinvest in our business, expand plants and R&D, or make other acquisitions and grow faster, create more value, become a more attractive employer, lots of other benefits. But
Yeah,
that's
well, let me just, with regard to this question, and I will then turn back to Senator McCaskill. You showed the board how this acquisition would play out at 3 tax rates, as I see it here. One is a 36% rate, which was very close to Salix's projected effective tax rate of 32, and then at 2 low rates you thought were possible after the acquisition, 5% and 10%. That's what's laid out in your materials. Looking at this page, the only scenario that shows Valiant hitting or exceeding this target at 20% internal rate of return was the company's lower rate scenarios. So again, assuming a share price of $160, Valiant projected that its internal rate of return on Salix would be 15.6%, as you said, at the U.S. rate, but would jump up to 21 and 22% at the lower tax rates. Isn't that right?
the numbers you called out is correct, but the debate at the board was whether the 15-16% was sufficient. The other scenarios are clearly meant to demonstrate the value to our shareholders, what they'll ultimately get if we're able to achieve those tax rates. But in terms of evaluating whether to go forward with Salix, the debate in the boardroom was whether accepting something lower than our targets was sufficient, was a good enough risk reward for our shareholders at that time. But again, the significant benefit is there in our hands, and our shareholders will get that benefit.
Well, given that Valiant projected that it would only reach your target, which is the 20% rate of return, by dramatically cutting Salix's tax bill, I think it's fair to say that tax savings were an important driver of the deal, particularly because you told us that you all are disciplined about it, which makes sense from a business point of view, that you are disciplined about your financial guidelines, and across the board, the majority of our transactions are delivered above that targeted 20% rate of return. Again, this is not about criticizing a company for looking at what the rate of return is and considering tax rates as part of that projection, but it is very clear to me in looking at the material you provided us, and this will come as no surprise to anybody who's looked at our U.S. tax system, that this is a significant reason that you all have proceeded not just with this transaction, but with other transactions, including the other two we've looked at in some depth, because there you were able to make your 20% return on acquisitions, and without the tax advantage, you would not have been able to. So again, I appreciate your providing the information to us. I do think this is an opportunity for us to dig a little deeper in these examples as we have in our report to be able to understand what the real consequences are of the U.S. refusing to change its tax code and what it means in terms of not just losing U.S. company headquarters, but also losing jobs and investment.